All right, let's get right into it. Today, we're diving into a professional, research-driven explainer mapping out the complete startup financing stack. We are going to cover exactly how founders fund companies from the very first dollars all the way to an exit, while maximizing long-term ownership and value creation. Because, look, if you're building a business, you already know running out of cash is fatal. But raising it the wrong way, well, that can be just as deadly.
So before we even look at a dollar sign, we really have to start right here. What kind of company are you actually building? Because your financing decisions don't just fund your business, they literally shape its entire future. The absolute biggest mistake founders make is treating different funding sources like they're just different ATMs. They aren't. They are entirely different ways to build a company, and they dictate your speed, your control, and ultimately, your definition of success.
To navigate this wild landscape, here is our roadmap. We'll hit the core funding trade-off, then look at friends, family, and bootstrapping. Next, we'll dive into early-stage safes and notes, navigate priced rounds, explore non-dilutive growth capital, and finish up with the honest math of maximizing your ownership. Let's jump in.
Okay, Section 1, the core funding trade-off. Basically, this boils down to cash flow versus growth pressure. Let's see how different models exert completely distinct pressures on you from day one.
You can really see the contrast here. Bootstrapping is all about capital efficiency. It's built on sustainable operations and keeping your ownership entirely intact. But man, it comes with immense personal strain because you are constantly solving for cash flow. Venture capital, on the other hand, is a rocket ship. VC absolutely expects you to solve for aggressive growth and category leadership. You're giving up a chunk of your company to pursue a much larger, faster, and frankly, far riskier outcome.
I love this quote. Capital allows companies to purchase time. Think about it. Venture capital isn't really just money. It's a weaponized tool to buy speed. If you're in a market with massive network effects, or maybe a rapidly closing regulatory window, a bootstrapped company might have the absolute best product on the market but still lose simply because it can't move fast enough. VC lets you hire faster, build the infrastructure, and capture that market before anyone else catches up.
Moving right along to Section 2, friends, family, and bootstrapping. Funding day one. Let's talk about those early days when customer pre-sales and your personal network are your first engines of growth. Now, bootstrapping beautifully preserves your 100% ownership by relying on customer-funded growth, which is fantastic. But, we have to be real about the downsides. You risk moving way too slowly against funded competitors. Plus, you're taking on massive personal financial strain. Get ready for a lot of ramen, right? And you completely miss out on the strategic network effects and talent pipelines that venture-backed startups can tap into from day one.
Now, if you do turn to your friends and family, and you actually want them to still speak to you at Thanksgiving, you have to treat it like a real securities offering. Vague handshake loans are a massive red flag for future institutional investors. You need to clarify exactly what you're offering, communicate in writing that this is high-risk capital with a 100% loss potential, and draft real formal agreements. Keeping your cap table clean from day one saves you from a wildly expensive legal nightmare later on.
All right, Section 3, early stage safes and notes. This is all about deferring valuation as you scale into professional investment. Let's look at this instrument showdown. Safes are incredibly popular right now. They're basically the standard for pre-seed. They act as a warrant for future equity. They're fast, simple, have zero interest, and stay completely off your balance sheet. Convertible notes, though, those are actual debt. They carry a 2 to 8% interest rate, sit as a liability on your books, and come with a strict maturity date, usually 18 to 24 months out, which literally forces you to raise a priced round or face repayment.
But here's the thing with safes. While they are wonderfully simple, the standard post-money safe has a real hidden bite. Actually, scratch that. It's a massive chunk. It locks in the investor's exact ownership percentage. So if you stack multiple early rounds, those new investors don't dilute each other. They take their slices directly out of your founder equity. You absolutely have to model this math out before signing anything.
Which brings us to Section 4, priced rounds and angels. The training wheels are off, your company is officially valued, and professional VCs step in. When you get here, this right here is your gold standard in term sheets, the 1x non-participating liquidation preference. You should always negotiate for this. It basically means that if the company sells, investors either get their original money back first, or they convert to common stock and take their percentage of the sale. They do not get to do both. It gives them fair downside protection without letting them double dip at the expense of you and your employees.
You also need to avoid the massive ego trap of an inflated valuation.
A huge valuation might sound incredible at a cocktail party, but it almost always comes with toxic conditions and impossible milestones for your next round, which just sets you up for a dreaded down round. Believe me, a clean deal at a fair, defensible valuation is 1,000 times better than a messy deal at an artificially inflated one.
Now, if you take money from strategic corporate partners, you must set strict boundaries. Limit their exclusivity so you aren't locked out of the market forever. Mandate strict information firewalls so they can't just use a board seat to snoop on your competitive secrets. And most critically, you need exit drag-along rights. Never, ever let a single corporate investor block a highly profitable sale of your entire company just because it conflicts with their internal corporate agenda.
Okay, Section 5, Growth Capital. Once you have predictable traction, new doors open for non-dilutive fuel. Let's look at debt and revenue.
Here are two distinct paths. Revenue-based financing, or RBF, is incredibly popular for SaaS right now. You get upfront capital and repay it as a percentage of your monthly sales. If sales dip, your payments dip. It's super flexible. Venture debt is much stricter. It generally requires existing VC backing and a solid 12 to 18 months of runway. You're looking at 12 to 15% interest, and they usually ask for 1 to 3% in warrant coverage, so they do actually take a tiny sliver of your equity upside. And please, don't overlook the classics. Government grants, SBA loans, or even crowdfunding can be incredible non-dilutive lifelines. Grants can fund heavy R&D without costing you a single share, and crowdfunding validates your product directly with your community while bringing in cash. These tools extend your runway massively while keeping your cap table totally untouched.
Finally, Section 6, Maximizing Founder Ownership. Let's wrap this up by looking at the honest math and the ultimate consequences of these choices over your startup's lifespan.
Look at this benchmark data. The reality of dilution heavily depends on what you're actually building. Startups building physical hardware products inevitably see much higher founding team dilution across every single stage compared to digital software companies. Physical goods require so much initial capital for R&D and manufacturing before you ever see a dime of revenue. So if you're building hardware, expecting a software-level cap table is just a mathematical pipe dream.
Ultimately, knowledge is just potential power. Running the math on all exit scenarios before signing a term sheet is how you protect yourself. But true actual power at the negotiation table, that only comes from generating leverage through multiple competing term sheets. A squeaky clean cap table and a highly competitive funding process are absolutely your best defenses against brutal dilution.
This quote cuts to the very core of this entire explainer. Capital is not the strategy. Capital should serve the strategy. Don't contort your business just to fit a specific funding model. If your market doesn't support massive hyperspeed scale, don't take VC. If you're in a winner-takes-all market, don't bootstrap and let a funded competitor crush you. Let the strategy dictate the capital.
So as you go out there and navigate your own startup financing stack, I want you to keep asking yourself this one question. Every single dollar you take fundamentally changes your trajectory and your control. 10 years from now, when the dust finally settles, will you still own the company you bled to build? Thanks for joining me for this explainer, everyone. Keep building and definitely keep those cap tables clean.